If you were like me and you didn't know anything about options, but that always intrigued you and you wanted to know more about it, because I'm telling you, once you know about it, these are great tools that you can add to your investment toolkit. They don't have to be necessarily high risk like everybody is thinking about when you tell them about options. They don't necessarily have to be like that. They can be an insurance on your portfolio. They can generate income. They can reduce the risk of owning certain stocks. Anyway, so if you want to learn about that, stay here. I'm gonna talk about the two types of options that exist. One are the calls and the other one are the puts. And so a call option, what is a call option? Well, let me go over to the option chain in my brokerage account right here. So this is an option chain. This one is for Pinterest for October 20th, which is 9 days from now. That's the expiration of the option. These are all the options for that specific expiration date and for Pinterest. And here we have the strike price. And here we have, on this side, we have the calls. And on this side, we have the puts. So what about calls now? Let's talk about the calls. So buying a calls or owning a calls, if you want to buy one, you are making a directional bet that the stock will go up. You are bullish if you're buying a call option, because what that gives you, it gives you the right, not the obligation, but the right to buy shares of that particular stock at expiration or before, if the stock price trades above the strike price that you define. The strike price is right here. So let me give you an example. So today Pinterest is trading at $28.56, and I think it's gonna go up, really up, but I don't want to buy shares right now. I don't want to spend like $2,900 on buying 100 shares of Pinterest. I mean, 2,853 right now, as you can see right here. I just want to see what the market is. I don't want to risk all of that. So what I can do is I can buy a call option, and I can select. So let me go a bit further. So let's go to November 17. So that's 37 days from now. So I'm thinking it's gonna go up 1 month from now. So, but I don't want to put all that money. So what I can do is I can buy a call option. And if I go on this side, this is the bid ask. So an option has a bid ask, just like stocks. This is where how you can buy it. So right now, that call option with the $29 strike price is worth $1.70, 71 cents probably. But because an option contract represents 100 shares, if you want to buy this one, you have to pay $171 right now. So if you do that, this is the contract you are getting into. So you have the right, not the obligation, to buy 100 shares of Pinterest at $29 on or before the expiration of that option. So on or before November 17. So if you're expecting that Pinterest is going to trade at $32 in November, then you're spending right now $170 or $1.71 per share to have the right to buy them at 29. So in that case, and if it doesn't, I mean, and that's the beauty of it. And if it doesn't, well, your option will expire and you hold it till the end. You don't resell it before. The option is going to expire worthless if Pinterest trades below $29. Let's say it trades at 26 and your assumptions turned out to be wrong. So you're just losing those $170 that you're putting to buy those shares. That's the entire risk you have. Now, if it goes up and it trades, let's say, at $32, you will have the right at expiration, if it trades at $32, you will be able to buy 100 shares of Pinterest at $29. So you are basically making the profit that would be the difference between the two. So if it trades at 32, so your profit is $300, but because you bought the option for 170, you're profiting $130, just the difference between the two. But this is how you can gain exposure to the stock without risking a lot of money, basically. So you're risking much less to gain exposure. And if the price rockets up, also the value of that option will rocket up, and you can also sell it back beforehand for a profit. So right now, maybe you're paying it $170, like we said, but maybe if tomorrow it jumps to $33, that option is going to probably be worth $350. So if you want, you can also exit that trade by just selling it back. So this is what a call option is when you buy it. What's the contract you are getting into when you buy a call option? Now let's talk about put options. So on the other side, you have put options, and you can buy a put options. This is a directional bet, same thing as the call option, but that's going the other way. You think the stock is going to go down. So if you buy that 27, for instance, this is a great way, by the way. People use put options to, like as an insurance. Let's say you own 100 shares of Pinterest, and you bought them at $27, for instance. Right now it's trading at $28.50, but you think it's gonna drop and crash tomorrow. So now if you buy that $27, or let's say the 28, you buy the 28, you're paying $150 for 100 shares. So you're paying $1.50 per shares. And this gives you an insurance that you can sell your shares at $28. So remember, you're expecting that the price of Pinterest is going to drop, but you're not sure. So you want to hold your shares. So you can buy that put option. You spend $150. It's like an insurance policy. So if it drops significantly, then you can still sell for a profit, because remember I said you bought them at 27. So you can still sell them at $28, but you paid $150 for the insurance of doing that. And if it goes the other way, it still goes up, and your assumptions turned out to be wrong, then you still have your shares that are going up, but you are losing just the $150 that you put for that insurance. So this is what put option can do. You are not obligated to own shares to buy a put option. It can be used as just making the directional bet to the downside, and these options will gain value. So the 28 will gain value if the stock price drops. So it's basically you buy a put option, price drops, and the value of that option that you bought is going to go up, and you can sell it back for profit. So if the stock price drops from $28.50 to $25, that 28 put options will probably be worth $300, and you can sell it for $300, and you bought it for $150. So you pocket the difference. Those are the two option types. This is how they work when you buy them. This is what they can be used for. This is not the trading style that I prefer. I prefer to generate income. These are one of the strategies that you can use with options, just buying calls, buying puts. For me, this is not my favorite trading style. This is not really what I use the options for. I prefer to sell them. There is a higher probability of profit on that side, because those ones are, let's say, a bit more risky, because options are decaying asset, meaning they lose value just over time by the passage of time. As we get closer to the expiration, if the price has moved, there's less and less chance that it will reach the price that you've selected. So I prefer to be on the other side, but that's not the point of this video. This was just to give you an idea on how puts and calls work and how they can benefit you if you want to buy them. So I hope this helps. If you want to learn more about options, go check out my website. It's affordfreetime.com. I have a lot of resources there. I have a newsletter that comes out every week where I give you tips about options and some education. That's where I notify also from releasing those videos. And I'll see you in the next video.